Hi, this is David with the Enzo Trading System. Today I would like to talk about the dangers of copy trading. I will show some examples of trades made by master traders, traders that broadcast their own trading signals to for other users to follow them. And this is going to be just a specific case of one trader, but it could be any trader. I actually went and picked the most popular trader of currently on one platform. So I went to one that is has the most following, which of course is likely to make the most impact in a broader sense. There are many platforms about copy trading, so this is only one. Things may vary depending on the platform and on the trader, but I will be showing this example because I think it's a good one. And first I should say what is copy trading. That's basically when a broker platform, an exchange allows for a trader to broadcast his own trades and for followers to follow those trades and have them executed on their own fund in automatic fashion. So it's pretty simple. Of course, one has to be very careful to pick the master trader, and here start the problems. First of all, even if you follow a trader that is successful, it's not really clear what the position sizing setup is. How much is this trader investing on this specific market for this position? I would assume that one should be able to invest all that wants to invest into that, or if anything, one should have a sense of what the master trader suggests. I haven't seen support in certain platforms about this, so it's really important not to take really seriously the asset allocation on your own and make sure that you allocate only a fraction of your fund instead of putting too much of your fund to follow this trader when you don't know really how confident this trader is with his own or her own trades. And then the second big red flag is that statistics they tend to be rather misleading. One thing that is often highlighted to define the goodness of a trader is the win rate or win ratio. And paradoxically, a high win rate is not a good thing. And if you get 100% win rate, it's actually a bad thing. It means that it is a trader that I mean, everybody makes mistakes when they do trades, but it doesn't want to admit his or her own mistakes by having a stop loss at a certain point. Another thing is the stats. They are short term, usually shown like the last week, the last few weeks. But really, to understand whether somebody's just lucky or as a method by which it's winning, one should have a longer term statistics. And of course, not just win rate, or maybe no win rate at all. And if that's not the case, then you're probably just following just a lucky guy that has made it to the top of the list of the traders on that platform, just because he had luck recently and the market is good, not because there is a method to his madness. So here I would like to go on with the example. Actually, what I did, I downloaded from one of these platforms. I downloaded recent trades. All that were available. I think it was a fairly new trader, and we have here I basically did a copy paste from the web page, and then through a script I converted into a CSV format, which I use in turn to display the trades in our own debugging trade debugging tool, which not an adaptation of our backtesting system. So here we have all the trades there. For this example, they're all on the Bitcoin market. There's a leverage used. It's always 4 times. There's whether it's short side or long side, opening price and closing price. and then opening date, closing date. And here there is a profit also shown, but we will be calculating that around, but it does match this. We will be calculating by ourselves, but it will match this. So, and let's see the statistics that we made from these trades. We can see if we don't consider leverage, because one has to assume, yes, the master trader is using 4x leverage, but those that are following, they may have a different level of leverage. So it's good to start from 1x leverage, so basically no leverage. We get total profit of almost 24% for 16 days, beating the market, which was basically flat. We have a maximum drawdown of 7%, and we'll be focusing on this. We have a return of a maximum drawdown is of course good because it's a profit divided by the maximum drawdown. Sharpe ratio is excellent. Sharpe ratio is usually a fairly decent statistic, but it doesn't work so well with the few trades, and it doesn't work so well in this case, which I will explain later. And the trades, there are 66 trades or 33 positions, and the winning ratio here 100%, which is a big big red flag. Very bad. Why is that bad? So let's see how the trader behaves with his trades. The first trade on record, it opens whatever price, 40k, 610. It closes at decent profit plus 1.7%. Again, we're doing everything without leverage, just the pure basis of the trades. The second trade that was on April the 13th, UTC, opens a long position, and then 6 days go by of drawdown, and then finally close at a tiny profit. So two things to highlight. The profit is tiny, but it's profit nevertheless. So this is what contributes to the winning rate. This trader never loses because he never wants to lose for as long as the market allows him to incur into that behavior. But most importantly, let's see the drawdown of this trade. So there is a tiny profit, but there is a minus 7% drawdown, meaning that the this actually it did incur in a risk of minus 7%, which is a lot for a position, especially if you're using leverage. But it never triggered any stop loss, so we don't know whether there was a sense of a stop loss at a minus 8% or a minus 20%, which would have been too huge for a single position. We just know that he's willing to take this much risk, which is too much, and definitely more than this, because nothing has been triggered here. I don't think the stop loss is going to be a 7.5%. So what this tells me is that it is somebody that just won't give up on a position, is not willing to take a loss after a while and then try again, just because it wants this sweet win rate. And unfortunately, at the psychological level, followers, they will favor this because everybody wants to see wins and nobody wants to see losses. And you can do that for as long as you're lucky, but after a while you're not lucky anymore, and then you cannot do that. So let's see. Let's go. Yeah, I mentioned this, the maximum drawdown, which I've shown here. It's about 7%, and it's not just this position, there are others. And one should make a clear difference between the maximum drawdown in which you have incurred and the maximum downside exposure, which is how much really is the trader willing to risk, which we don't know in this case because we don't know the strategy. If at any point there is actually a strategy, or if somebody that just buying and hoping, which I think is probably the case. So the maximum downside exposure we cannot infer. We just know that is more than 7% for an open position. And then unleveraged. And then, there's another thing, another example of bad behavior, which is again not necessarily just this trader. A lot of traders, I think virtually anyone that has ever done any trading has done these mistakes, taking this much risk. And that one, actually, before showing that, a leverage for time, we had to show that, yeah, the profit would have been great, but that 7% becomes 28% drawdown. And again, in a single position, and that's not even the maximum. So 28% at 4 time leverage is not bad as a maximum drawdown on crypto. But for a single position, that's bad. It means it's willing to lose a lot in just one swoop. Usually when you reach this much, it's a series of bad positions, bad market. But at least, you know, you're getting there step by step and not risking to get into liquidation, which is the big problem with leverage. So the second bad behavior that I would like to highlight, again, in this specific case, but it's a common behavior people do. I did it myself when I tried to do some manual trading, and that's when I gave up very quickly. It's to buying into a losing position. So in this case, there's a purchase here right after a drop. This is on April 26th, again UTC, 5 p.m. buy. So supposedly one is hoping the price to go up, and then it goes down, and so it keeps adding to the losing position. So now, compared to the initial risk, now we have 4 times the risk. And so the maximum drawdown for this position is really only 3%. But then there is the other one, and then there is the 2% for the other one, and then the 1%, 1.5, and then 1%. Altogether, they make another 7%. And then you can see that's the typical behavior of somebody that just doesn't want to lose, doesn't want to take a losing position. It will start to close the positions again only once the initial one, it's in slight profit. And here, close 1, close 2, 3, and 4. And so the win ratio continues to be 100%, but it's completely risky behavior. And most importantly, especially if you're a copy trader, maybe you could say as a master trader, yes, I opened this position here, but I only allocated a fraction. But a copy trader doesn't really know. And I bet also the master trader didn't know that. It just, you know, if the master trader knew that a better position would have been at this level, he would have bought here. Simply one buys, sees a losing position, and keeps thinking, I will, it will return back up. So I believe even more into this, because the more it goes down, the more it goes up. And the problem with this is that it is often true. The more it goes down, the more it goes back up. But then there is that one time, there's few times, maybe during the year, where that's not true. You keep piling in, adding in into losing position, and then you end up losing everything. Especially if you're with leverage. Because if you're with leverage, a 4-time leverage, it only has to go down 25% once, and all that you have invested is gone. Of course, you probably haven't invested 100% into something like this, but comparatively to what one has invested into this system, will make a lot of money, here, and then lose it all in a few hours, perhaps. And I mean, everybody loses at some point or another, but this is just risky behavior. And that's what you incur into. And really the point is that if you look at the stats, this is a guy that never loses, but in fact, it's a guy that is taking a lot of risk so that he never loses for as long as the market continues to bounce back up. But then eventually he won't do it. And that's when everything goes to crap. But the master trader probably is only investing a few $100. And I should mention here that what I'm highlighting is somebody that has hundreds of followers. So I could be a master trader and maybe spend 2-3 weeks being lucky with the new account, getting all the win ratio all the way up, get 100, 200, 300 followers that invest hundreds of thousands, I don't know, millions of dollars. and I get a chunk of that, and then as soon as I lose everything, too bad, you know, I close my account with $300, and I keep the profit that I made up to that point. That's the big problem with copy trading. Really, you shouldn't really follow somebody that is showing great profits and great win ratio for a limited time. If it is somebody that's, you know what the strategy is, what is his maximum downside, and it shows a track record of multiple years, it's open about that. But usually what you copy is just a nickname with 100% next to it. And the number of followers, that's another thing. The more followers you get, the more followers you're gonna get. The more followers you have, the more you're gonna get. And then eventually it's a bigger and bigger crash. Yeah, then what should I say? Yeah, just, I mean, if you had to go copy trading, don't do it with the strangers. That would be my advice. And if you can, look for maximum drawdown more than profit. How much is that? How much risk has that trader incur into? But that's not enough, because it doesn't really tell you what's the maximum downside. Ideally, the only thing that you can guess is that if it is 100% win rate, that means that person doesn't have a stop loss, and so the maximum downside is probably 100%. If you get a reasonable win rate, I don't know, it really depends on the style and how really good you are. And normally our best algorithms we get, depending on the market, we get between 30 and 50% win rate, hardly ever above 50%, at least long term. If you get something too high, it doesn't smell right. You should probably run away. 100% guaranteed. Somebody's taking way too much risk. But the profit curve looks great. The maximum drawdown is actually not that bad. Comes to show. So I don't really have a better statistic that shows this. One could put together something. I really haven't had to do it for ourselves, because we know what our maximum downside exposure is. We have our own stop losses. So it's not like we have to find out if we have some bad algorithm as far as risk goes. But probably one could make something between profit, maximum drawdown, and then win rate, and it should actually be something inverse to the value of the win rate, so something like that. But yeah, that's it for me. If you have any comments and questions, I'll leave below the video the usual links to our Discord. If you want to know about our system, we're always open. I hope that this was useful. I think the thing that I highlighted here is not just one trader, it's what everybody does at some point. If you have to trade this way, you shouldn't do it at all. Either you find the proper way, you can factor in the risk management, or you should give up. That's my really heartfelt, honest suggestion as far as trading goes. That's it. Yeah, bye.